And today we have with us John Ragano, who's been working with me to help people get the homes of their dreams for over the last 10 years with me. But more importantly, he's been in the financial services sector around buying homes for the last 25 years. So John's going to help us out with answering the most basic of questions. But if we've got any more questions in this, we certainly can arrange a tailored meeting to go over your individual circumstance. So John, welcome today.
Thanks, Chris. Thank you for having me.
And so what I've done is I've compiled about 6 questions that we kind of want to go through and just give people basic answers to here for this home buying webinar, and just to give people a little bit better of an understanding. And then we'll give them an avenue where they can reach out to you after today's presentation to be able to get some of their more personalized questions answered as well. So I'm going to let John take it away here, but we're going to start off with the question of pre-approval versus pre-qualification, and really what's the difference between those two?
Thanks, Chris. Yeah, this is a common question. If I talk to 10 applicants, all 10 are going to ask, a version of a pre-qualification or a pre-approval. And to me, the reality is they're one and the same. They're interchangeable. One term doesn't outweigh another. I think to keep in mind, what lenders need to do is, in order to give a pre-approval or pre-qualification, number one, they're going to need to get your identifying information so they can pull your credit and assess your situation from that standpoint, and then talk about your income, how you're employed, whether you're a W-2 employee versus a self-employed or a commissioned type employee. So the term pre-approval and pre-qualification are interchangeable, and they really, one does not outweigh the other. It's really the lender assessing the situation, and then he can say, you're pre-approved for this property or this price point that you're looking to buy.
Okay. And so, for example, if someone was to go into my website, go into the lending page that we've got there, they could put in their information through there and upload documents using your turnkey system to be able to get a basic pre-approval or pre-qualification, depending on how much information they give you.
That's correct. So What happens is when they do that, I'm notified that they've gone in and applied. I'll pull in the information. They've consented to authorizing me to pull their credit, and I'll pull the individual's credit information, take a look at it, and then speak to that person to really then talk to them on what they're looking for or what their needs are, like how much money they have to work with, or what extent of the price point of a home they really want to look at. The common question is, how much am I pre-approved for? That's a common question that everyone asks. I think that they think lenders plug information into a system and it spits out a number that is, $437,622. And it really doesn't work that way. So what I always talk to borrowers about is help them understand is it's not how much you're approved for that's important. What's more important is how much of a monthly payment are you going to be comfortable with? And I think that's what we keep in mind. So I could qualify somebody for a $600,000 home, but they're not going to be comfortable with that payment. They're going to be more comfortable maybe with a payment starting at the $500,000 range. So that's what I do after they've applied, and we go in and we talk one-on-one and put their needs in order.
Fantastic. And I know this question is not on our slide here, but on the previous slides, we just went over the importance of a funding letter. Quick aside, what's the latest that we've ever gotten you out of bed to write a letter for us on the weekend?
Does after midnight count?
That would be perfect. One of the things that people have a lot of questions about are interest rates. And, I see a lot of people get lured into other organizations with, hey, you're ready for the super low rate. Yeah. And it's kind of like they're selling you the keys to heaven and they're not showing you where the gate is. How are interest rates determined, and do they change?
That's, once again, I hear that all the time. And so all we can do as a lender, just so you know, anyone, you cannot lock into a specific interest rate until you have a ratified contract. So until you, Chris, present an offer to a seller and that contract's ratified, that's the moment you can lock into an interest rate. So oftentimes I see people that have gone to credit unions or to some big banks and they have an interest rate posted on there. Well, it's interesting. A lot of times they send them this information. Some of them haven't even pulled their credit. And so when you determine interest rates, credit scores definitely play a role in how your interest rate is determined. The lender is just following Fannie Mae guidelines. So Fannie Mae and Freddie Mac, they set up levels of price adjustments, if you will, interest rate adjustments, not price, but interest rate adjustments based on your credit score, also in relation to the down payment you're making. So there's a lot of variables that come into play. So when people oftentimes get letters with an interest rate on it, they have a perception that that's what their rate is. And number one, not only is they're not guaranteed that rate, oftentimes there's more of a cost for that interest rate that they're not aware of and they don't find out till later.
Gotcha. And when you mean cost, what do you mean by that as far as cost for the rate?
So if you can imagine interest rates, call it what we call it par. We call that level, or call that ground zero.
Yeah.
And if you wanted to get a lower interest rate, there's going to be a cost associated with that. So for example, let's say we're talking about an interest rate of 3%. And that was, if I said someone, here's an interest rate at 3% with no points. And what that means is, let's say their loan amount's $500,000. And I say the interest rate's 3% with no points. And they say, well, I want a lower interest rate. Okay, well, we can provide that. There's going to be a cost associated with that. So let's say they said, well, I want 2 3/4% for an interest rate. Okay, I have to then, based on their credit and based on their debt to income ratios, I look and I say, okay, 2 3/4 is going to cost you 2 points. Well, what is 2 points, Chris? 2 points is 2% of the loan amount. Okay, so 2% of 500,000 is $10,000. Okay, and what happens is, what you have to assess is that 0.25% reduction may lower your payment, let's just say $100. So it's costing you $10,000 to lower your payment by $100. And that's where, as a lender, you have to provide, insight to, okay, is that valuable for you? Sure, over the life of the loan, that's going to save you interest that you pay. But in the grand scheme of things, where you stand today, there's a lot more you could do with that $10,000, like, renovate,
right.
Do some improvements to the home when you move in. So the cost and discount points, that's what you mean by lowering. That's what happens when you have to lower your rate.
You got to really want to stay in that house for a long time.
Yes.
Yeah.
Correct.
And the average is about every 7 years. So it might not make sense for most people, especially that are on this call. Now, what are the different types of loan, and how do people know which one is available for them? Like people that don't know the process come in, they call up a lender, they're trying to figure out what their options are. How do you work with them so that you figure out which loan type is best for them?
There's 3 types of loans. There's a VA loan, which is for veterans. There's conventional loans, and then there's FHA loans. Those are the 3 programs that are out in our industry. And I always ask that on the, as part of my assessment when I'm talking to individuals is, do you or have you ever served in the military? And because they may qualify for a VA loan. VA offers a lot of, they offer a 0 down payment option, okay, which is pretty attractive for buyers. So you could have no money for a down payment. All you have to do is pay for your closing costs. So that's one aspect. And if they don't have VA eligibility, then we go to conventional financing is probably the most common for consumers. Conventional, just real quick, has a lot of requirements that most people fit into, but they really look a little tighter at your credit scores, your debt to income ratios, things like that. And then finally, you have FHA loans, which are a very good loan for people. A lot of first-time home buyers like it, but you don't have to be a first-time home buyer to qualify for an FHA loan. They only have like a minimum of a 3.5% down payment. One of the attractive things about FHA loans are they allow for higher qualifications when it comes to debt to income ratios versus a conventional loan. And what that means is if someone is looking, let's say, at a price point of $450,000, and let's say that's their maximum from a debt to income standpoint for a conventional loan, but they're more attracted to maybe a home that's at the $525,000 price range, right? That's $75,000, right? That's a big difference, right? You know, that's a whole different type of home in some aspects. Well, then they make a determination. Then we could look at an FHA loan because they provide for higher debt to income ratios, which might provide for the borrower to buy more of a, more expensive home than they could buy conventional. So a lot of moving parts. Yeah. And FHA, finally, just to say, is they're not as they're a little bit more user friendly when it comes to mid to lower credit scores.
Gotcha. So they're a lot more flexible and easier to work with as far as how much debt you're carrying and what you're trying to do.
Yeah, if you've had some bumps in the past with your credit, or you've had some, let's say, from 2 or 3 years ago, and your credit is on the rise, your credit scores are on the rise and they're trending upward. They may not be at a advantageous point for conventional, but they're well suited for an FHA loan. Affords you the opportunity for home ownership.
Yeah. Now, there's always like the myth of Bigfoot, right? And so the big thing is, and we look back at days of past in the 2008 era, and even a couple of years ago, where people and credit unions were offering 0 down payments. What are the down payments that you're seeing in today's marketplace?
Well, with the exception of a VA loan, right? So a VA loan, as I said earlier, they don't require any down payment. It's a great loan. So that one is user specific, right? You have to have VA eligibility, and we can find that out for a borrower. Setting that aside, you're left with conventional and FHA loans. Depending on the price range you're looking at, you can do a conventional loan with as little as 3% for a down payment. And the FHA requires a minimum of only 3.5% for a down payment. Those are your standard down payment requirements for those two loans, with exception of from state to other municipalities. You have a lot of down payment assistance programs, like in Virginia, it's Virginia Housing Development Authority, VHDA. They provide a 0 down payment, plus they'll even pay some of your closing costs for a transaction. However, you need to fit into their box, and their box is really tight. It's credit score driven, it's debt to income driven, and it's income driven. If you make too much money, you may not fit into their program. But that's once again, that's a unique product that my job is to provide you with the information and see where these programs best fit for you.
Cool. And then how many times have you heard in your lifetime, do you have to pull my credit?
That's what it started to. Now we live in a pretty highly educated area, and now, with all the advertisements and marketing, now it's evolved. That one I've heard for years. Yeah. And then the second one I hear now is this going to be a hard pull or a soft pull on your credit? Let's just, cut through the smoke. It's a hard pull. I mean, a lender if you're going to talk to 2 or 3 lenders, you're going to have your credit pulled. And we pull from an agency that pulls all 3 credit bureaus: Equifax, TransUnion, and Experian. And when we say your credit score, let's say someone's his Experian score is 710, his Equifax score is 720, and his TransUnion is 730. Okay, we're going to use that mid score of 720. And so when we say your credit score is 720, that's how we have to do it. We take your mid score of your 3 scores. The soft pull, the hard pull, a lender's it's a hard pull. And there's a lot of myths out there, these programs, there's a lot of credit monitoring services and that say, hey, don't let the lender do this. We're going to have to do it because our credit score that we use or that the services that we get are a little different than what the consumer gets when they get it from their credit card or credit monitoring services. So that's a big difference. But keep in mind one last thing about the credit score. If you go to 5, 6, 7 different lenders in a 30-day window, let's say, and all five of those lenders, however many, pull your credit, the model is going to count those credit inquiries as one inquiry versus if you went to 5 different credit card companies and applied for them, those would be 5 separate inquiries, thus possibly impacting your score a little bit. When the lenders do it when all 5 of the lenders' inquiries count as one, your score stays the same.
Gotcha. And we kind of touched upon it a little bit. So the consumer-based companies that are providing credit scores, they're not as accurate as.
Absolutely. Yep.
Yeah. So you'd agree with that?
Yeah, I call it what they're providing as a warm blanket. It makes you feel good on a cold night. The reality is this. I mean, the best example I give is what they're doing is providing you a perspective of here's what your credit score based on how they're scoring your credit data. Okay, they're not assessing any risk at all. Our industry is risk-based assessment. So when they give you a credit score, let's say you had a 30-day late payment on a particular credit card, and on a scale of 1 to 10, 10 being the worst, that credit monitoring, that credit card company, they may only ding that late payment for like a 2. Well, when the industry credit score models that all lenders use, that 30-day late payment might ding you for like a 5 or a 6 because we're assessing risk. Keep that in mind. Those models that provide those services, they're not lending you anything. So they have there's no risk to them. So where I see it the most is when people have had some credit things in the past or maybe some credit struggles and their credit scores are trending upward and they have a mid-range score, let's say 680. We'll see that I'll generally see that their score when I pull it from a risk-based credit scoring system that we use, the industry uses, you might see that score at maybe 660. Okay, because it's just going to be a little difference. In the same scenario, if someone has really good credit or good credit with score, they've been told they've got a 740 score or 760. Most of the time when I pull that score, their scores are going to be fairly close to that. But those are people that probably haven't had any late payments in the past or things of that nature. So once again, it's experience by the lender to know and to explain the differences in the credit scores and why they are that way.
Excellent. And is there any last advice that you would give to people that are looking in the marketplace right now as far as it relates to lending?
Yeah, it's experience of the lender.
Yeah.
Local lenders. I mean, I'm fortunate. I've been here, as you mentioned earlier, 25 plus years doing this. And what we've seen over time is, as I said, every loan is different. I've done that. I've said that from day one. It's just like everyone's credit file. Everyone's credit file is different. I can't tell you how many, married couples who say, oh, our scores will be the same. No, they won't. They think, well, we have the same amount. There's just data that gets scored and information is slightly different in one form or fashion. So every loan is different. When someone says, well, I'm pre-approved by this bank over here, what I've found, and I'm not saying anything disparagingly, I just what my experience shows, is a lot of your bigger institutions, whether they're large credit unions or large banks, they'll take your information and they pull your credit, like you've heard me talk about, and they say, oh, your credit's great. And let's say you have a 750 credit score and you're qualified for 500,000. And you go down the road and they give you this piece of paper saying you're pre-approved. Once again, that pre-approval isn't really going to do you any good when they meet with you as a realtor, right? And then you have to go make an offer and you're making an offer on a place that's 450,000 or it's 550, that listing agent is going to want to see a pre-approval letter that is specific to that property and specific to that sales price. And, you know, a letter that has a generic, like a to be determined property, isn't going to get them much. So the bottom line is, here's the important thing to take away when you're dealing with the big places. They sometimes don't go in depth on your credit qualifications. Are you, and your income? Are you self-employed? Are you W-2 employed? Are you a commission-based employed? Things of that nature. They just pull your credit. They see you got a good score and they move you along in the process. And they may not find an issue out until 2 or 3 weeks into the process, where it could have been picked up front.
Cool. And so if you want to learn more about John, all you've got to do is go to the web materials that I provide you. You'll be able to log on right from my site, be able to put your information in so John can assess it and schedule a tailored meeting with you to go over your specific situation. So John, I want to thank you for coming on today and helping us understand the lending process and how you all fit into the actual home buying process.
My pleasure, Chris, and thank you again for having me.
Fantastic. Thanks, John.